Hi, my name is Eric, and I will be reading selections from Barron's magazine, the e-edition, for the issue date of September 1st of 2025. We'll start with Up and Down Wall Street. Why does this crazy stock market keep ignoring Jack Bogle's Iron Rule by Andy Serwer? Now that NVIDIA earnings and summer have come and gone, we can turn our attention back to the never say die market, writ large. Truly, this bull market is like the infamous Russian mystic Rasputin. It just can't be killed off. Stubbornly high interest rates, a bewildering series of tariffs, slowing job growth, and housing market weakness. What's a squishy macro environment got to do to get some attention around here? Sure, the rose-colored glasses crowd can argue that unemployment remains low at 4.2%, wage growth is strong at 4.1%, and gross domestic product growth was solid at 3% in the second quarter. Net-net, though, there's a stronger case that the market's shrugging off warning signs rather than basking in the glow of an America is great again-essence. After all, President Donald Trump's badgering of Federal Reserve Chair Jerome Powell to cut interest rates suggests that POTUS himself thinks the economy needs some goosing. Not that Mr. Market needs any help flexing, with the S&P 500 index up 10.2% this year, following gains of 23.3% last year and 24.23% in 2023. That plus the S&P's price-to-book ratio of 5.34, exceeding the 5.05 of 1999 just prior to the dot-com crash, coupled with a trailing price-to-earnings ratio of nearly 30, suggests that investors are operating in ignorance is bliss mode, which raises the question, why does this market keep going up? There are the usual suspects: accommodating Fed policy, the artificial intelligence revolution, and the Trump TACO taco trade, but another theory's been making the rounds lately: the death of reversion to the mean. That stock prices revert to a mean, articulated by Eugene Fama and Ken French among others, has long been an accepted premise of investing. Reversion to the mean, said Vanguard founder Jack Bogle, is the iron rule of financial markets. But what if it weren't true anymore, or at least not as true? There are at least a couple of variations of the end of mean reversion, one put forth by Adam Cecil of Gravity Capital Management, author of Where the Money Is, Value Investing in the Digital Age. Cecil wrote up his theory 6 years ago in Barron's, and it's aged well. When Cecil started his career as an analyst at Sanford Bernstein, he was schooled that stocks immutably reverted to the mean. But are Kohl's, Target, and other bricks-and-mortar retailers going to come back, Cecil asks? And on the flip side, is Amazon.com going to revert to the mean on the downside? E-commerce has 15 to 20% of retail sales in the U.S. Is that number going down? Cecil sees that in 2004, 19% of the market's value was tech. In 2024, it was 46%. And it's unlikely to decrease as tech giants like Microsoft and Amazon are growing multiple times faster than the economy. Emerson said a foolish consistency is the hobgoblin of small minds, Cecil notes, plumbing the great transcendentalist. It's going to be consistent, but when the world changes, not so much. A more radical end of mean reversion theory comes from Michael Green of Simplify Asset Management. Green argues that passive investing, which now accounts for $17.59 trillion, or 53.4% of all mutual fund and exchange-traded funds, according to Morningstar, tends to make the market continually rise. Green, called the Cassandra of passive investing, argues that investors in passive funds are more likely to hold during downturns and choose to reinvest in their funds, resulting in passive fund managers consistently pouring money into stocks. Given that the S&P 500, the index of choice, is market cap weighted, more and more money flows into NVIDIA and the other members of the Magnificent Seven. Green says this mean expansion is the reason the market keeps going up, or at least not down. The rise of passive investing has been studied by the likes of Felix von Moltke of Oxford and Torsten Slok, Apollo Global Management's chief economist, who together wrote that passive investors have contributed to reduced price elasticity and market responsiveness, which in turn have led to amplified price movements, decreased liquidity, potential macroeconomic inefficiencies, and a disproportionate concentration of market influence in a few dominant stocks. Once Vanguard has bought Tesla, do they respond to an earnings report in Tesla? No, says Green. That shrinks the effective float in Tesla and raises the volatility of the move in response to an earnings miss. Green believes that mean expansion grossly overinflates equity valuations, which worries him. I've modeled this stuff out, and unfortunately all of these models say you end up with a horrific crash, he says. It's worth noting that Bogle told me in 2017 if everybody indexed, the only word you could use is chaos, catastrophe. The markets would fail. He also added, what are the chances of everybody indexing? It's zero. Still, not exactly comforting. Which brings us back to Rasputin. In 1914, he was stabbed, but survived. 2 years later, he was fed cakes poisoned with cyanide, but he survived. And then he was given Madeira wine poisoned with cyanide, but he survived. Then shot, but he survived. And finally shot again and then thrown into a river. And at that point, he died. Eventually, this bull market too will expire and revert to the mean. Our next headline, Warren Buffett turns 95 today, 10 of his biggest investing lessons, by Andrew Barry. Warren Buffett celebrates his 95th birthday on Saturday, marking a milestone of longevity and leadership at Berkshire Hathaway. Buffett plans to step down as Berkshire CEO at year's end after 60 years at the helm. He leaves an extraordinary legacy as an investor and manager. He took control of a struggling textile company in 1965 and has turned it into the world's largest conglomerate with a market value of over $1 trillion and annual after-tax operating earnings of about $45 billion. Here are 10 lessons or takeaways from his long career. Investors may not agree with some or many of them, but they are worth considering. Don't pay up for stocks. Buffett generally doesn't pay more than 15 times forward earnings for a stock. Even when buying growth companies like Apple nearly a decade ago or Coca-Cola in the late 1980s, Buffett bought them for under 15 times earnings. Number 2, don't be afraid to take profits, even if it means paying a lot in taxes. While Buffett preaches forever investing, the reality is different. Berkshire has cut its formerly huge stake in Apple by 70% and reduced its interest in Bank of America by 40% over the past year or so. In recent years, Berkshire has exited sizable holdings in J.P. Morgan Chase, Goldman Sachs Group, Citigroup, and Paramount Global, among others. The only 2 forever stocks in the Berkshire portfolio could be Coke and American Express. Number 3, stick with what you know. Buffett retains a 20th century mindset to his investments. Buffett owns few new economy stocks. And it's the same story with Berkshire's wholly owned businesses, which are led by insurance, railroads, and utilities. Number 4, start early. Buffett was following the markets as a boy and reading investment periodicals in the Omaha Public Library. He made his first investment, Cities Services Preferred, in 1942 when he was 12. Seek out great teachers. Buffett was captivated by value investor Ben Graham's book, The Intelligent Investor, which was published in 1949. Buffett went to Columbia Business School, where Graham taught, and went to work for Graham's investment firm before striking out on his own. Don't be afraid of concentrated investments. 5 stocks, American Express, Apple, Bank of America, Coca-Cola, and Chevron, made up almost 70% of Berkshire's equity portfolio of roughly $300 billion at the end of the second quarter. Buffett's own portfolio is hyper-concentrated, with over 99% of his net worth in Berkshire stock, a stake now worth about $150 billion. Hire great managers and let them do their thing. Berkshire grants far more autonomy to the top executives of its subsidiaries than virtually any other big company. Don't retire too soon. Buffett doesn't believe in retirement at 65 for himself and for his top managers. Buffett's approach has paid off for Berkshire investors, as the stock is up 30-fold since he turned 65 in 1995. Be stingy with share issuance. Berkshire hates issuing stock for acquisitions and has never offered stock compensation to anyone at Berkshire. Everyone gets paid in cash. That's paid off big time for Berkshire holders, as the share count is up just 40% since Buffett took over in 1965. Buffett focuses on growing per share intrinsic value. The per share part of that rule is critical. And finally, do something you like. Buffett has always loved his work, saying in the past that he tap dances to the office every day. Berkshire's Buffett's baby, and he isn't giving it when he relinquishes the CEO job, since he plans to remain chairman. He told shareholders at Berkshire's annual meeting in May that he also plans to be in the office daily in 2026. Not surprising for someone who said a few years ago that he was always on the clock for Berkshire. Berkshire investors are hoping he stays on the clock for at least several more years. Happy birthday, Warren Buffett. You can write to Andrew Barry at andrew.bary@barrons.com. In precious metals, the headline reads, "Gold is smoking, but there's one way you don't want to play it," by Debbie Carlson. Leveraged funds that own gold are up by triple digits this year. They can fall just as fast. With gold up roughly 30% this year and gold mining stocks up even more, gold-focused funds that borrow money to amp up returns are on a tear. The $701 million Direxion Daily Gold Miners Index Bull 2x Share ETF is up 188.5%, and the $542 million ProShares Ultra Gold 2x ETF, which seeks to provide twice the daily performance of the COMEX gold futures contracts, is up 55%. What's not to like? Well, if you're a buy and hold investor, a lot is wrong. Leveraged bets can produce sharp gains, but they can also make you very poor very quickly. How poor? Well, look at what happened to the leveraged funds this year that bet against gold miner prices. The $125 million Direxion Daily Gold Miners Index Bear 2x ETF, an inverse fund that seeks to profit when prices fall, is down 74.5% year to date. Leveraged funds are designed for traders and others making short-term bets. They are for someone who's buying gold for the classic reasons investors own the yellow metal, which is a portfolio diversifier, an inflation hedge, an insurance policy, or an alternative currency. How leveraged funds work. Most leveraged funds are structured as daily average products. If the underlying investment moves by a certain percentage on a particular day, then the leveraged ETF is designed to move by a multiple of that, says Anikat Ulal, head of ETF research and analytics at CFRA Research. That said, a fund that has 2x leverage won't move exactly twice the amount of its underlying asset for two reasons, Ulal says. The first is the financing cost. Many of these funds use derivative contracts known as swap agreements for the leverage, which has a cost. The second is the volatility of the underlying asset. Volatility tends to distort returns over time when it comes to leveraged funds. That can be seen by comparing gold's year-to-date return versus the ProShares fund. The ProShares fund is up 55%. However, gold is up 29%. So the fund's return is about 3 percentage points short of being up twice gold's return. Another real-life example of the volatility drag happened in April when markets were whipsawed following the White House's tariff announcements. The Van Eck Gold Miners Fund was up 6.6% for April, But the Direxion leveraged fund, which uses the VanEck fund as its underlying index, rose 9.9%. A true doubling would have put the Direxion fund's April return at 13.2%. It gets worse. There are times when the underlying asset can have a positive return and leveraged funds can lose money, such as during 2020's extreme market moves. Morningstar data show the VanEck fund rose 23.7% that year, but the Direxion leveraged fund lost 60.2%. The 2020 example shows how time magnifies these distortions, says Curtis Congdon, president of XML Financial Group. That's why he says that leveraged gold fund should only be used for short-term trades. I think the people who look at levered gold ETFs are misplacing the effectiveness of gold in a portfolio, and perhaps instead should be looking at technology stocks rather than leverage gold ETFs, he says. Ed Eagalinsky, managing director at Direxion, says this year's stellar return for leveraged gold miner funds is unusual because it's rare that a market goes straight up with little volatility, has been the case for gold miners. He says investors shouldn't count on leveraged gold funds going up smoothly. To me, that's fool's gold, because most markets don't go up straight up with some sort of volatility to the downside, he said, adding, I wouldn't recommend people hold these indefinitely. Gold is a strong uptrend now, buoyed by central bank buying over the past few years, but the metal has had years of little price movement in the past. After its last run in the 1980s, gold saw range-bound trading until about 2005. If you buy a leveraged gold fund, you need to know exactly what you're owning. Not only does leverage vary, but the products are also different. Most leveraged gold investment products are ETFs. At least one, the $877 million Microsectors Gold Miners 3 times leveraged ETN, is an exchange-traded note. An ETN is an unsecured debt instrument issued by a financial institution, but it trades like an ETF. ETNs introduces counterparty risk if the issuer can't pay, leaving investors on the hook. ETN defaults are rare, Ulal says, but they remain a risk. Overall, he says, those are best left to buyers who understand these complex products. If they understand the concept of volatility decay, and also the fact that these things can be so volatile, I think that's the key. My experience has been that not a lot of investors understand all of that, even financial advisors, he says. In bonds, the headline reads, Bond spreads sit near 1998 lows. What can push them higher? By Karishma Vanjani. America's safest companies are paying investors historically low rates for the risk of defaulting on their debt. It's a boon for companies, and it's unlikely to change soon. Credit spreads, or the extra yield on riskier debt over virtually risk-free government securities, is at 0.78 percentage points, close to the low of 0.75 percentage points, which was seen back in July of 1998. The result is reduced borrowing costs for blue-chip companies, all while their stocks run hot. The S&P 500 gained $5.13 trillion in value this year. Investors currently find the total return on corporate bonds attractive, despite the small additional compensation for risk. This is especially true in an environment where worries about recession have eased, and the government's high spending has put a black spot on the alternatives, U.S. Treasuries. The biggest source of demand for IG credit today remains all-in yield buyers. Steve Caprio, head of credit strategy at Deutsche Bank, tells Barron's. These buyers prefer credit today over U.S. Treasuries, given concerns over fiscal deficits. Over this quarter, since July to Wednesday, investors poured in $49 billion into exchange-traded funds with investment-grade bonds, the most inflows over the same period since 2022. In the same period last year, $6 trillion moved out of these funds. Spreads have been tight for months, and a summer lull in new supply likely further pressed them down. In July and August, issuance of new investment-grade debt slipped under $100 billion, according to J.P. Morgan. In short, there was too much money chasing too few assets. Supportive supply and demand technicals over July and August have pushed spreads into uncharted territory, an uncomfortable position that underscores the need for protection against a downturn, wrote Goldman Sachs' chief credit strategist Lotfi Karui. What can freak out markets and widen spreads? Much lower than expected U.S. economic growth could cause longer-term Treasury yields to drop, even as spreads or demand for risk premium widen on corporate bonds. U.S. credit spreads are on borrowed time, says analyst Tan Kai Zhan of Gavekal Research. Corporate balance sheets are healthy and companies are easily able to pay interest, but tariff hikes and continued uncertainty could tip the economy into recession, he wrote in his note on Thursday. Other reasons for higher spreads, according to John, could be increased supply of corporate bonds or lower long-term Treasury yields if the U.S. government decides to finance more of its deficit with short-term debt. September is typically a month of higher new corporate bond supply, where the market has seen an average of $133 billion come in over the past 4 years, according to Eric Beenstein, head of U.S. high-grade credit research and strategy at J.P. Morgan. Out of this, $65 billion has been issued during Labor Day week. The bar is high for worry. Any shift of supply dynamics in the corporate credit or treasury market won't imply any stress in the market, and will likely push spreads higher only temporarily. What the market needs to get spreads at, or near, its 10-year average of 1.24 percentage points isn't a technical change, but true panic about the economy. Now, the bar for a meaningful sell-off has risen, Caprio said. At this stage, a weak job hiring report wouldn't be enough. It would take a negative non-farm payrolls print or a more forceful rise in jobless claims and continuing claims to get the market's attention. Investors are in a tricky spot. Historically low spreads mean there's a significant room for spreads to go wider from here if the economic outlook worsens. But things aren't terrible by any means, nor are they as wonderful as the 1998-like spreads suggest. We don't expect a recession, and credit default rates are generally only occurring in select pockets, but there is enough growth weakness ahead to worry us, especially given tight overall valuations to start, Caprio added. In a Markets Review column, some boring stocks are beating big techs. Plus, you can sleep at night, by Teresa Rivas. In a rally powered by the Magnificent Seven, boring can still be beautiful. Hopes for artificial intelligence and quantum computing garner headlines, and it isn't all hype. Big tech profits are expected to grow faster than for the S&P 500, and margins are seen as holding up too. That said, after tech's recent sell-off, investors may be looking for less volatile options, and they don't have to trade gains for stability. That's the gist of a report from Torsten Slok, chief economist at Apollo Global Management. He says some big tech stocks are being outdone by what might be considered humdrum names. Take Tractor Supply and Apple. The ag retailer has outperformed the iPhone giant since 2001. In the past 5 years, Tractor Supply has more than doubled, compared with Apple's 83% gain. And then there's Domino's Pizza and Alphabet. Since 2007, the pizza company has outperformed the internet giant. And Old Dominion Freight Line gained roughly 56% over the past 5 years, compared with Amazon.com's just over a third. The bottom line is that fancy tech stocks are getting so much attention, and investors spend a disproportionate amount of time discussing their growth strategies and new products, wrote Slok. But numerous other stock and investment strategies can deliver better and more stable returns with fewer sleepless nights. It makes sense that "may you live in interesting times" is understood as a curse, not a blessing. What happened last week in markets? The Jackson Hole rally fizzled as the week began. On Monday, President Donald Trump tried to fire Federal Reserve Governor Lisa Cook, although she hasn't been charged with anything and vowed not to resign. Stocks rose. Nvidia results beat expectations, but its shares fell on China uncertainties. The administration doubled tariffs on India to 50% and ended tariff exemptions on small packages. The S&P 500 and Dow Industrial set highs on Thursday, and then they fell on Friday. On the week, the Dow fell 0.2%, the S&P 0.1%, and the Nasdaq Composite 0.2%. Summer's over. In companies last week, the Trump administration ordered Ørsted to stop work on $1.5 billion wind farm off Rhode Island that was 80% completed. SpaceX successfully launched a test flight of its Starship rocket. Elon Musk's xAI sued Apple and OpenAI, claiming antitrust violations. Interactive Brokers joined the S&P 500, replacing Walgreens Boots Alliance, acquired by Sycamore Partners. The Wall Street Journal reported that ExxonMobil held talks with Russia's Rosneft on restoring its pre-Ukraine war partnership. Trump fired his recently confirmed CDC chief after she clashed with Health Secretary Robert Kennedy Jr. over vaccines. In deals, Keurig Dr. Pepper said that it would buy coffee company JDE Peet for $18.4 billion. The plan to split the company into coffee and soft drinks, unraveling the 2018 merger of Keurig and Dr. Pepper. AT&T will buy Spectrum from EchoStar for $23 billion. What's happening this week? On Monday, September 1st, equity and fixed income markets are closed in observance of Labor Day. On Tuesday, September 2nd, the Institute for Supply Management releases both its manufacturing and services purchasing managers' indexes for August. Consensus estimate for the manufacturing PMI, released on Tuesday, is for a 48.9 reading, about a point more than in July. Expectations for the services PMI, released on Thursday, are for a 50.5 reading, a bit higher than previously. On Wednesday, September 3rd, two megacap tech companies highlight an otherwise light earnings calendar. Salesforce reports quarterly results Wednesday, and Broadcom weighs in on Thursday. On Friday, September 5th, the Bureau of Labor Statistics releases the jobs report for August. Economists forecast a 75,000 increase in non-farm payrolls, 2,000 more than in July. The unemployment rate is expected to tick up to 4.3% from 4.2%. Another report showing weak jobs growth would all but cement an interest rate cut at the Federal Open Market Committee's mid-September monetary policy meeting. Traders have priced in a 90% chance of a cut. By the numbers, 21.6%. Once rare 7-year car loans as a percentage of all car loans. They surged as cars got more expensive. $1.2 trillion. How much companies worldwide are expected to spend on software this year? Up some 11% from 2024. 205,000. The estimated drop in U.S. net immigration in 2025, driven by closed borders, deportations, and out-migration. And 30%. That's the rise in the world futures contract for Arabica coffee in August. It's the biggest monthly gain since 2014. From the trade section of this week's Barron's, dated September 1st, a tariff exemption just closed. Expect delays, shortages, and higher prices by Reshma Kapadia. The end of a rule that allowed low-value parcels to enter the U.S. duty-free could make those goods more expensive and harder to get, a particular setback for low-income households and small businesses. While the Trump administration closed the de minimis exemption for Chinese products in May, it went further on Friday. Now the shift applies to all foreign goods valued at under $800. In the firing line are apparel, cosmetics, and small household appliances, but also dietary supplements, many electronics, medicines from Canada, and gourmet items from Europe. The exemption had allowed roughly 1.36 billion packages into the U.S. a year without duties or much scrutiny, the administration said. It had been a popular route for discount Chinese retailers such as Shein and Temu, who have rapidly gained market share in the U.S. The Trump administration has said it had also been a route for deadly synthetic opioids to enter without scrutiny. Friday's move could bring in an additional $10 billion a year in revenue, according to Peter Navarro, an advisor to President Donald Trump on trade and other issues. At the same time, though, a variety of products are expected to cost more and to become harder to find. Analysts are expecting disruptions in shipping and logistics, such as customs processing, that could result in shortages or delays ahead of the year-end holidays. The cost to consumers could be an estimated $13 billion, or about a fifth of the costs of the tariffs the Trump administration imposed in his first term, according to a 2024 paper by Yale economists Amit Khandelwal and Pablo Feigelbaum. The biggest hit, the economists argue, will be borne by lower-income households. The duo's work indicates that 73% of what the lowest-income zip codes in the U.S. purchase falls under the de minimis exemption. That's compared with just about half for wealthier zip codes. Lower-income consumers tend to spend relatively more on de minimis shipments, and their de minimis shipments tend to be relatively more from China, Khandelwal said via email. Shipments that fall under the de minimis exemption make up the bulk of cargo by volume, but a small portion of the overall value of imports. It isn't a big thing for the broader economy versus other tariffs, and considering the U.S. imports nearly $3 trillion, said Gary Hufbauer, the director of studies at the Center for Foreign Relations and a non-resident senior fellow at the Peterson Institute for International Economics. It isn't a macro thing, but an important micro thing, said the former Treasury official. This is a blow on low-income folks and small businesses. Whereas multinational companies have teams of specialists to help them deal with trade law, Hufbauer says the $800 exemption threshold was one of the few customs provisions favorable to smaller businesses and less wealthy households that tends to shop more for these goods. While the end of the exemption could help domestic producers and retailers, it could also cause issues for smaller businesses that relied on foreign suppliers for lower value goods. The additional paperwork they now will face could be more cumbersome than the additional tariffs, Hufbauer says. To the extent that they respond by choosing not to import, there could be less availability of some of these lower-priced products. The change is also creating logistical headaches that could feed into higher costs. Whereas some of these items were being shipped to Mexico or Hong Kong and then shipped into the U.S. in smaller parcels, companies are now consolidating their orders and looking to warehouse them so they could be brought into the country under a single set of paperwork, says Nick Ovanessian, an account executive at the freight forwarder OEC Group. Others are trying to spread out the tariff hit by unloading goods at bonded warehouses and taking goods as needed, Ovanessian says. The result is that prices for warehousing are skyrocketing as everyone scrambles for limited space. How much of these costs is passed on to consumers isn't clear, but Khandelwal doesn't expect exporters to absorb it all. Many exporters are hitting pause as they think about their next steps. The change could also result in delays, especially for goods to clear customs. The Customs and Border Patrol, already overwhelmed, now will be tasked with scrutinizing a mountain of small-value packages. The timing of this change couldn't be tougher, with peak season already straining fulfillment networks, says Anne-Marie Junkman, Vice President for Global Industry Strategies at the supply management firm Blue Yonder. Added clearance steps for low-value shipments will increase the risk of port congestion, delivery delays, and cost pressures just as demand spikes for the holiday buying season. Analysts' advice to consumers: shop early and look for deals. Some retailers could end up with too much inventory as they try to adjust for the shifts in trade policy. From the electric vehicle section of this week's Barron's, dated September 1st, Tesla stock drops as Musk's SEC battle takes a new twist. What to Know by Al Root. Tesla stock fell Friday as CEO Elon Musk looks for a home court advantage in his battle with the Securities and Exchange Commission. SEC matters can be serious but shouldn't be all that significant for Tesla stock. Instead, the recent legal filings offer investors something else: where Musk spends his time. Shares of the electric vehicle maker traded as high as $348.75 Friday, but they gave up those gains, leaving them down 3.5% at $333.86 at the close of trading. The S&P 500 and Dow Jones Industrial Average fell 0.6% and 2%, respectively. The moves come after Musk's legal team filed a venue transfer motion on Thursday from Washington, D.C. to the U.S. District Court for the Western District of Texas. The court has an office in Austin where Tesla is based. This case, which concerns a single allegedly late-filed beneficial ownership form in April of 2022, should be litigated and adjudicated in the Western District of Texas, reads part of the filing, where the defendant and key percipient witnesses reside, and the overwhelming majority of the relevant events occurred. The ownership form related to stock in Twitter, now X, that Musk had accumulated while preparing to make an offer for the company. Jared Birchall, managing director of Musk's Austin-based family office, Accession LLC, estimates that since 2020, Musk has spent roughly 60% of his time in Austin. My work covers numerous facets of Mr. Musk's life and businesses, including but not limited to his business ventures, philanthropy, political work, and personal and legal matters, reads a statement from Birchall in support of the venue change. Because of my extensive dealings with Mr. Musk across many aspects of his life and businesses, I am knowledgeable about Mr. Musk's whereabouts, his work, and his travel schedule. Spending lots of time in Austin near Tesla is something investors want to hear, especially after Musk spent large parts of early 2025 in Washington working in the Trump administration. As for the venue change, Barron's cannot handicap the legal arguments. It would appear to benefit Musk since his legal team is the one asking. It's easier to predict that Musk's current battle with the SEC won't impact Tesla stock all that much. A prior battle over Musk's 2018 funding secured tweet cost Tesla a $20 million fine. The case related to Tesla also cost Musk a $20 million fine. Better reasons for Friday's swoon were Tesla's recent strength and NVIDIA. Coming into Friday trading, Tesla stock was up about 8% over the past 5 days, and NVIDIA stock lost 3.3 to 4% on Friday, falling for the second day since the company reported better than expected second quarter earnings on Wednesday evening. NVIDIA is a key AI investment, and investors view Tesla stock as an AI play. What happens to one AI stock can often impact others. Tesla stock needed to close above $340.01 to notch a fourth consecutive weekly gain. Friday's weak performance snapped that winning streak. Coming into Friday trading, Tesla stock was down about 14% year to date, but about 68% over the past 12 months. In manufacturing, Caterpillar stock drops as it resizes its tariff hit. Why Wall Street Isn't Worried by Al Root. Caterpillar stock dropped after the company updated the impact of tariffs on 2025 earnings. Investors don't seem happy, but Wall Street isn't worried. The company on Thursday said the net impact of import levies would be between $500 million to $600 million for the third quarter and approximately $1.5 billion to $1.8 billion for 2025. That's up from prior guidance provided in early August of $1.3 billion to $1.5 billion. Caterpillar shares fell 3.7% to $419.94 on Friday, while the S&P 500 and Dow Jones Industrial Average lost 0.6% and 0.2%, respectively. Since the company released its second quarter earnings on August 5th of 2025, several additional clarifications and additional tariffs have been announced, reads part of Caterpillar's release. The company now expects its full-year adjusted operating profit margin to be near the bottom of the target margin range. Sales guidance is unchanged. Revenue is expected to be almost $65 billion, according to FactSet, slightly higher compared with 2024. In 2023, CAT provided a range of profit margins at various sales levels. At $65 billion, margins should land between roughly 16% and 20%. Wall Street currently projects about 17% margins, so estimates might come down roughly a percentage point, removing some $500 million in operating profit. Baird analyst Mig Dobra lowered his 2025 earnings estimate by $1.05 to $17.40 following the update. He cut his price target $5 to $495, but still rates shares a buy. CAT remains a top idea, he wrote on Thursday, adding that dealer inventories are in better shape, which is a positive for CAT sales in 2026. While tariff and price headwinds remain frustrating, we appreciate management's proactive approach in providing timely intra-quarter updates with the added clarity, likely a positive differentiator relative to peers. The fact that CAT is seeing more tariff impact with the latest guidance on Section 232 steel and aluminum tariffs is of little surprise to us, following what we heard from OEMs at trade show Farm Progress, wrote Citi analyst Kyle Menges on Thursday. We think international machinery makers are facing more impact than CAT is, which could be a boon to CAT's market share in North America, and we think that should make it a bit easier for CAT to mitigate tariff impacts. He rates shares buy and left his price target at $500. Overall, 54% of analysts covering CAT stock rate shares a buy, according to FactSet. The average buy rating ratio for stocks in the S&P 500 is about 55%. The average analyst price target for CAT stock is about $454 a share. Coming into Friday's trading, CAT stock was up 20% year to date and up 25% over the past 12 months. In the markets section of Barron's magazine this week, stocks end August on a down note. Why investors should prepare for a September swoon by Paul R. LaMonica. The stock market ended a sweltering August on a sour note, signaling perhaps an early start to a September swoon. Investors should be ready to put cash to work. The Dow Jones Industrial Average fell about 0.3% this week, dragged lower by a Friday sell-off following another report showing persistent inflation pressures. The S&P 500 and Nasdaq Composite were each down 0.1%. Despite the downbeat end to the month, all three indexes have rallied between 1.5% and 3% in August, and they're near record highs. Now it's off to September, historically the worst month for stocks. It's easy to list the reasons it could live up to its reputation, but investors are counting on the Federal Reserve to save the day with a rate cut when its meeting ends on September 17th. There is reason for optimism on that front, even if it's due to economic pessimism. The August jobs report, due out Friday, September 5th, is expected to show that only 92,500 jobs were added, up slightly from the disappointing gains of 73,000 in July, but still relatively sluggish growth. The good news, though, is that the slowdown doesn't seem sharp enough to set off alarm bells, even if it sends an all-clear signal on rate cuts. But there are other worries still percolating. Producer and consumer inflation data are due September 10th and 11th, respectively. Investors are still wary about the potential for tariffs to hurt consumer spending and corporate profits. Even rate cuts aren't a given, says Kayla Cedar, multi-asset manager and macro strategist with State Street Global Markets. One of the biggest risks is the excitement about the future of rate cuts. She thinks the Fed will remain data dependent, which could mean that more rate cuts later this year aren't guaranteed. Despite her worries, Cedar believes any concerns about the Fed and rates will be offset by expectations for higher earnings growth, thanks to the recently signed stimulus bill in Washington, which should lead to 11% earnings growth in 2025, followed by 13% growth in 2026, according to Wall Street analysts. We see more upside for equities, she says. The new tailwind is the one big beautiful bill, which provides incentives for all companies, but especially tech. Don Townswick, Director of Equity Strategies at Conning, however, is looking for opportunities beyond the Magnificent Seven. It's a valuation issue. While the S&P 500 trades for 22.5 times 12-month forward earnings, and the Round Hill Magnificent 7 exchange-traded fund fetches 29.2 times, the Invesco S&P 500 equal weight ETF trades for just 17.2 times. The rest of the market is reasonably valued when you factor in expectations of rate cuts and positive earnings, Townswick said, adding that guidance for the rest of the year from many companies is nothing short of spectacular. So, if there is a September slump for stocks, it would be a good time to go bargain hunting, just as it was after the post-Liberation Day pullback in April. September has often been the worst month for the market, but if we see a correction, that's more of a buying opportunity, says Crit Thomas, global market strategist with Touchstone Investments. Add that up, and it looks like investors don't need to be too spooked by September after all. In the markets section, these were the best and worst S&P 500 stocks in August by Mackenzie Tatanani and Nate Wolf. August is one of the sleepiest months on Wall Street, but some stocks still swung wildly this year as summer came to a close. A few trendy technology names brought up the rear in the S&P 500 index amid a series of lackluster earnings reports. Many of August's winners, meanwhile, staged late summer recoveries after brutal starts to the year. Here are the month's top risers and fallers as of Friday's opening bell. Albemarle outpaced the index in August, climbing 26.8%. The company was one of several lithium producers to get a boost due to a sharp rise in the price of lithium, a key component in electric vehicle batteries. Fears of supply snags helped. Albemarle climbed 7% on August 11th after Chinese battery maker Contemporary Amperex Technology paused production at one of its mines. Shares entered August more than 20% up for the year. Intel stock climbed 25% in what was a roller coaster month for the U.S. chip maker. On August 7th, President Donald Trump called CEO Lip-Bu Tan conflicted and demanded he resign over alleged ties to Chinese firms. The pair quickly mended their relationship, and within weeks, the U.S. government made an $8.9 billion passive investment in Intel, becoming its single largest investor. Add that to a $2 billion investment from Japan's SoftBank, and you get a banner month for the stock, which came into August down narrowly in 2025. IDEX Laboratories rose 21.1% in August after a blockbuster earnings report August 4th. The Maine-based veterinary supply company reported better than expected results for its second quarter and lifted its fiscal year earnings forecast to between $12.40 and $12.76 a share, a 40-cent boost at the midpoint. IDEX stock has climbed 56% this year. Human resources software company Dayforce jumped 20.9% for the month, but it won't be trading on public markets much longer. The company reached an agreement in August to be taken private by private equity firm Thoma Bravo in an all-cash deal worth $70 a share, delivering a 32% premium for stockholders. The deal is expected to close early next year. If United Health Group is going to rebound from a wretched first half of the year, August was a good start. The insurer climbed 20.6% for the month, buoyed by Berkshire Hathaway buying about $1.6 billion worth of stock. The bet from Berkshire CEO Warren Buffett comes as healthcare stocks languish at their cheapest valuations in 30 years. Even after the stellar month, United Health stock remains down 40% this year. Other stocks have been pummeled this month, such as Trade Desk, which plunged 37%. Shares crashed on August 8th following the ad tech company's second quarter earnings report. While results were largely in line with expectations, management cautioned that revenue growth would likely slow in the third quarter. That grim outlook, coupled with the sudden departures of CFO Laura Schenkein, announced on August 7th, appeared to spur investor panic. Supermicro Computer fell 28% in August. Worse than expected earnings for the fiscal fourth quarter might have had something to do with it. While Supermicro's revenue guidance for fiscal 2026 was encouraging, its guidance for fiscal first quarter revenue and adjusted earnings missed Wall Street forecasts. A sell-off in stocks linked to the artificial intelligence trade at the end of the month caused shares to slump yet again. Despite the declines, Supermicro remains up 37% this year. Tech-oriented research firm Gartner had a challenging month, falling 27%. Commentary from CEO Gene Hall on August 5th caused shares to close at their lowest level in 3 years and see the largest same-day percent decrease since 1999. Hall remarked that confidence among chief executives in the U.S. had dropped to recessionary levels in the second quarter. The company also cut its full-year revenue forecast, which overshadowed an otherwise solid earnings report. Fortinet stock declined 21% in August. Shares sank on August 7th after the cybersecurity company posted numbers that edged by estimates, but issued a weak outlook for firewall product upgrades. Analysts remarked at the time that they saw a challenging setup going forward, as the industry refresh cycle for firewall services appears to have peaked earlier this year. Rounding out the list of the biggest losers was Coinbase Global, which fell 19%. The cryptocurrency exchange reported below consensus earnings after the closing bell on July 31st, causing the stock to tumble and extend its losses into the next day. Shares fell on August 5th after the company unveiled a convertible note offering worth up to $2.3 billion, raising concerns about potential dilution. Then Coinbase declined yet again in mid-August amid a broader sell-off in fintech stocks. From the AI section of this week's Barron's magazine, NVIDIA and other AI stocks are falling, why investors are souring on artificial intelligence, by Nate Wolf. Wall Street appears to be cycling out of the artificial intelligence trade as August comes to an end. Virtually every major company connected to the AI boom fell sharply on Friday. The losses extended from chip makers such as NVIDIA and Advanced Micro Devices to CoreWeave, which provides infrastructure for data centers, and Vertiv Holdings, a manufacturer of power and cooling equipment for the computers at their core. State Street's Technology Select Sector SPDR, exchange-traded fund which tracks semiconductor companies, software makers, and other tech stocks, was down 1.7%. Reasons for the sell-off are varied, said Mizuho Securities' Dan O'Regan in a note on Friday. He pointed to a post-earnings malaise for NVIDIA, which reported its results Wednesday, saying a few negative headlines about AI may also have caught traders' attention. NVIDIA was down 3.1% in the second full session after the report. While the company posted solid results and issued a better-than-expected outlook for the current quarter, that wasn't enough for investors. O'Regan suggested that some traders may be taking profits because the results included no news that could bring gains, and because the shares had a strong run heading into the earnings print. With earnings now behind us, investors are asking, "What's next?" he wrote. Developments in China were also making waves. Alibaba Group, the country's largest cloud computing company, has developed an AI chip that may be an alternative to NVIDIA's H2O units, the Wall Street Journal reported on Friday. While the chip's performance and adoption remain to be seen, it's another sign of China's accelerating efforts to build a homegrown AI ecosystem, O'Regan said. The U.S. Department of Commerce also revoked a program that allowed Samsung Electronics, SK Hynix, and Intel's China subsidiary to export U.S. chip-making equipment. The move, which gives the trio of companies 120 days to apply for new licenses, may put further strain on America's tech relationship with China, O'Regan wrote. It is possible that Friday would have been a tough session for AI stocks regardless of the news. Many traders on Wall Street may have jetted off to the Hamptons or Nantucket for the Labor Day weekend. Liquidity is very tough, O'Regan pointed out. Selling anything becomes exponentially harder and can drive prices lower. With active managers out on vacation, O'Regan said he's heard some chatter that algorithmic traders may be rebalancing their holdings to end the month. Based on the lack of real institutional volume from active managers we're seeing, that probably has some validity to it, he added. And we'll close with a story from the oil section. Mexico has oil. Why it isn't an energy powerhouse, by Craig Mello. National oil companies are meant to be cash cows for their governments. Not in Mexico. Fully state-owned monopoly Petróleos Mexicanos lost $30 billion last year. Production has dropped by half over the past 20 years to about 1.6 million barrels a day. The company is $100 billion in debt, despite serial cash injections from the Mexican Treasury. President Claudia Sheinbaum lately unveiled a recovery plan aimed at getting Pemex off the state dole by 2027 and adding 200,000 barrels of output by 2030. It'll probably fail, as Sheinbaum clings to the nationalist philosophy of her predecessor and mentor, Andrés Manuel López Obrador. People were hopeful for Sheinbaum's energy policy when she was elected last year, says Duncan Wood, senior advisor at the Inter-American Dialogue. A lot of that optimism has faded away. Mexico has rich potential petroleum resources to replace the dwindling elephant fields it struck last century, but they're either in deep water in the Gulf or in a belt of shale reserves that stretches south from the U.S. border. Exploiting either will require capital and expertise on a large scale from private oil giants outside Mexico. López Obrador's predecessor, Enrique Peña Nieto, opened the door to such collaboration in 2013 and 14 with promising results, said Carlos Ramirez Fuentes, a partner at Mexican consultancy Integralia. All the majors came into the country and committed billions, he says. López Obrador, elected in 2018, slammed that door shut. We're suffering from a perverse energy reform, which was approved for looting and theft, he declared. He reined in Pemex's own exploration in deep water and shale, too. Sheinbaum has hinted at a more moderate tack, floating what she calls mixed public-private contracts. Such a mechanism would be absolutely, entirely insufficient to attract big market participants, Fuentes asserts. It's not the way this is done anywhere in the world. López Obrador further damaged Mexico's attractiveness for investment with a judicial reform, allowing for the replacement of all the country's judges by 2027 that he rammed through toward the end of his term, says Nuria Jorba, a debt analyst who follows Pemex for Von Tobel Asset Management. This constitutional shift, which Sheinbaum has vociferously defended, will see all of Mexico's judges elected, challenging the rule of law from investors' point of view. Investors with very long time horizons will be careful before engaging in this institutionally complex environment, Yorba says. And with that, we've come to the end of our reading of Barron's Magazine with an issue date of September 1st. This was produced by the Audible Local Ledger, a reading service exclusively for people who are blind or have low vision. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.